If Canada's biggest companies load the wagon and head south, are Canadian investors riding shotgun or left at the curb? The United States just rewrote the tax playbook. And the new rules, wrapped into a law called the One Big Beautiful Bill, make it almost irresistible for Canadian headquarters to migrate. Think of One Big Beautiful Bill as a flashing neon sign that says, move your talent, your code, and your capital here, and keep more of every dollar that you earn. Here's the headline change. Every dollar spent on research, AI chips, data centers, or automation gear can now be deducted in full immediately. No 5-year trickle or 7-year drip. For a company the size of, say, Shopify, that single tweak alone erases about $300 million of first-year tax. At a lower rate on overseas sales and friendlier foreign tax credits, and Shopify can drop its effective tax rates from roughly 26% to maybe the mid-teens. Look, that's real money. Money that's suddenly not flowing into Canadian coffers. And this isn't just a tech story. Canadian Pacific, Kansas City, our cross-continental railway, can now expense locomotives, track automation, even next-gen logistics software on day one. If shifting the mailing address south saves hundreds of millions, directors have a duty to crunch the numbers, don't they? The same logic, of course, applies to Magna, Nutrien, TC Energy, Couche-Tard, Thomson Reuters, CGI, and Constellation Software. Any firm with big U.S. investment cycles or global sales. All told, we're talking about $30 to $40 billion in Canadian pre-tax profit that's, well, let's call it in play. At current rates, that's $7 to $10 billion in annual corporate tax Ottawa stands to lose before we count the lawyers, accountants, and community support that follow a head office. Look, Mark Carney saw this coming, didn't he? Long before he became Prime Minister, he chaired Brookfield Asset Management and helped steer it toward U.S. tax advantages. So if it was prudent then it's practically a boardroom obligation now that the One Big Beautiful Bill sweetens the pot so much. I'm sorry to say, but prudence beats patriotism when shareholders demand returns. So Canada faces a bit of a stark choice, doesn't it? We can either match the U.S. breaks, take a short-term deficit hit, but keep our champions at home, or we can gamble that corporate patriotism will, pardon this, trump mathematics. History suggests the calculator wins. Now, here's the part where you and we have agency. As investors, we can tilt portfolios toward companies and jurisdictions that benefit from these policy shifts. We can diversify our tax exposure and adopt structures that let us keep more after-tax dollars, no matter which side of the border writes the friendlier rules. We should all wish our elected leaders success as they come to grips with these significant challenges that we face. Our future depends on it, and I have confidence that in the end, we'll find a proper path through this. I'm Glenn Evans from Evans Family Wealth. Remember, we're here to help.